morning, everyone. Welcome back to ET Now. You're watching Market Cafe with me, Kanishka Sarkar, and Shreyansi Singh. Well, over the next 1 hour, we'll get you top developments from India and around the world, and also tell you about the stocks to keep on your radar today. But first things first, let's take a look at the handover that's coming in from the US. Shreyansi, sharp declines on the Wall Street overnight.
Well, absolutely, Kanishka. That just about sums it up. You do have a lot of moving parts to that entire puzzle when it comes to the tariff front. We've seen a lot of headlines coming in. Of course, you do have that sharp sell-off, like you just mentioned. Dow dropped more than 970 points. That's the kind of sell-off that you saw coming in for the Dow Jones Index as well as S&P 500 and Nasdaq Composite, because both of these indices also slid more than 2%. Monday, in fact, also marked the fourth straight losing session when it comes to Dow as well as the Nasdaq. So that's the kind of move that you saw coming in. You do have futures at this point tied to the Dow Jones as well as S&P 500 and Nasdaq that are gaining at this point. But in terms of the regular trading session, you did see that sell-off coming in. You do have investors that are increasingly uncertain when it comes to Trump posting on Truth Social that the economy would slow. That is something that is that is definitely rattling the markets, and you did see that reflected when it comes to all three of those indices. Now, in terms of the start to the week, of course, this was a very weak start to the week. So let's see if this sort of momentum is something that we see a continuation of. You do have Trump also hinting at Powell's termination. There is that entire war of words. So there's a whole host of factors when it comes to all of this. There's already a turbulent period for stocks when this sell-off is something that you're seeing, because you do have Trump's initial announcement as well of reciprocal tariffs. That has already rocked financial markets, and on the back of that, you do have all three major indices that have tumbled more than 9% since Trump first unveiled his plans for the levies on April 2nd. So that's the kind of move that you're seeing, at least as far as the Wall Street is concerned.
Well, absolutely. Fourth straight consecutive session of declines for US stocks. Now, moving on, let's also get you a crude check quickly. Oil has fallen more than 2% in signs of progress in US-Iran talks amid more market stress. Now, Brent crude futures slipped $1.70 or 2.5% to close at $66 a barrel, whereas the US WTI settled at $63 a barrel, down $1.60 or 2.5% on Monday. Now, in terms of talks, the US and Iran have agreed to begin drawing up a framework for a potential nuclear deal. That's what Iran's foreign minister said. This is after discussions that a US official described as yielding very good progress. Now, this progress follows further sanctions by the US last week against a Chinese independent oil refinery that it alleges processed Iranian crude is ramping up pressure on Tehran. Now, markets also came under stress yesterday after US President Donald Trump last week made criticism about the Federal Reserve, as you rightly mentioned earlier. Now, gold prices rose to another record, with jitters rippling into energy markets due to concerns about demand. That's as per the analysts. That's what the analysts have been saying. Now, speaking of gold, the yellow metal prices have reached past $3,400, hitting a new record, as President Donald Trump's threats against Federal Reserve's independence and his tariffs shake investor confidence in the US economy. Now, gold futures jumped almost 3% to close at $3,425 per ounce. Now, this is with investors buying the precious metal as the dollar hit a 3-year low. Now, gold has jumped about 30% since the start of this year and about 8% since Trump unveiled those sweeping tariffs on April 2nd.
Well, absolutely, and that deadline, in fact, has been very key, right? When you take a look at the levels coming in as far as gold is concerned, and even for Wall Street. But let's take a look at what you should be looking forward to in terms of global cues, because you do have Eurozone as well as consumer confidence data, and that is something that we're keeping an eye on. Other than that, in terms of global earnings, you do have Tesla reporting its numbers, SAP, Verizon. All of those will remain in focus on the back of their earnings. And back home, of course, you do have HCL Tech. That one's going to be in focus on the back of its earnings. Now, when you take a look at the IT pack, you do have some sort of resilience that we've seen come in, despite a muted set of fourth quarter earnings as far as some of those IT companies are concerned. So let's really see if that is something that we see a continuation of when it comes to HCL Tech as well. But moving on, when you take a look at CIE Automotive as well, that counter will remain in focus on the back of it being the last day to buy shares to be eligible for dividend. And of course, you do have the IMF also issuing the World Economic Outlook. That's also something that we're keeping an eye on. And in terms of speeches, Fed Governor Adriana Kugler is also going to be speaking. That is also going to be something that you should be watching out for in terms of commentary, any sort of clues when it comes to the monetary policy as well. And other than that, of course, PM Modi is visiting Saudi Arabia, so that visit is also something that we're keeping an eye on.
Well, absolutely. Lots of important cues to watch out for later in the day. Now, moving on to some top headlines we're tracking this morning. US President Donald Trump ramped up his attack on Fed Chair Jerome Powell, calling him a major loser. Now, in a post on his platform, Trump, in fact, also warned of an economic slowdown in the United States if interest rates aren't lowered immediately. He claimed that there is currently virtually no inflation and that costs for energy and most other things are on the decline. Now, calling for Powell's exit, Trump says his termination cannot come fast enough. However, remember, Powell has flatly stated that the president cannot remove him as per the law.
Rather than moving on, keeping it going with Trump, he also met with major retailers, including the likes of Walmart, Home Depot, and Target to discuss tariffs and how they are likely to raise costs of everyday goods that they import. Important to note here that big US chains like Walmart and Target rely heavily on imported goods, and tariffs, including 145% levies on China, are expected to add strain on Americans already burdened by prolonged inflation.
All right, then shifting focus then. Now, Japanese investment bank and brokerage group Nomura said it will buy North American and European public investments business of Macquarie for $1.8 billion. The all-cash deal is expected to close by the end of this year, subject to regulatory approvals. Now, Nomura said that it has identified global asset management as a key strategic growth priority for the organization, adding that this would increase their assets under management to $770 billion versus the $590 billion currently.
Other than some of those visuals that you just saw from a very important visit, Prime Minister Narendra Modi warmly welcomed US Vice President J.D. Vance, his wife Usha Vance, and their children at his official residence in the national capital on Tuesday as well. The Prime Minister, in fact, recalled his visit to the United States and his discussions with US President Donald Trump. Further, the two leaders reviewed bilateral relations and also discussed enhanced cooperation in the energy as well as the defense space. In fact, the Prime Minister also told the US VP that he's looking forward to Donald Trump's visit. In fact, we do have Sumita joining in with the highlights and to also tell us what's on the agenda for the rest of his visit. Sumita?
Yes, in fact, I'm coming to you live from Jaipur, and if I can ask my camera person to pan across, these hoardings have come up that are welcoming the Vice President J.D. Vance. Remember, this is one hoarding, there's another hoarding here. So I'm standing right in front of Jaipur's famed Rambagh Palace, where J.D. Vance is actually staying with his family, and he will also be meeting the Rajasthan Chief Minister in a short while from now, and then he will be heading on for some sightseeing and cultural activities, including visiting the Hawa Mahal, visiting Amer Fort as well. And after that, he will be giving an address, a closed-door address to academicians, some politicians as well, a think tank people and researchers, etc. on perhaps, and that will be something that will be keenly watched out for, because it will give a broader headline, a broader outline of how US-India ties are being seen by the United States globally. Remember, this is a very, very important visit also from the point of view of the fact that there is a 90-day tariff reprieve that has been brought about by the Donald Trump administration. And yesterday we saw that meeting that happened between the Prime Minister and, of course, Vice President J.D. Vance as well, wherein both sides appreciated the progress that's been
All right, then thank you, Sumita, for getting us those live updates from JD Vance's visit to Jaipur. A very power-packed day, in fact, for the US Vice President. Now, moving on, let's go across and listen into what former ambassador and representative of India, Jayant Dasgupta, had to say about JD Vance's visit to India.
The FM needs to, and I'm sure she would be doing it, to reach out to the Fortune 500 companies, the CEOs, for instance, because they will be the ones, as Professor Joshi has also pointed out, who will be our best advocates for H1B and and so that the US doesn't tinker with it, the median salary, etc., which makes it almost impossible to operate. Various things are, being contemplated. So I think this is a time when we need to build bridges, not only with the US administration, but also with US industry.
Well, it's really just diplomacy that's in focus bright and early this morning. In fact, we at TT Now do have some more coverage on these lines and more diplomatic outreach. You do have the finance minister who said that India is actively engaging with the new US administration, also hopes to conclude the first tranche of the bilateral trade agreement positively by September to October this year. Remember that she's in the US to attend key IMF as well as World Bank meetings. We do have Sumit Chaturvedi joining in with the highlights of her visit.
Well, yesterday, when she landed, she met Indian diaspora. She addressed them and told them about India's vision of Viksit Bharat and what India is doing to achieve that. But just a few hours ago, she met tech CEOs, the tech company CEOs, those CEOs including Google Cloud CEOs, partner of A16Z and Amware CEOs. So some of them were Indian origin CEOs. So the discussions happened around how tech is shaping the world, but India can play its part. India is making leaps in AI, artificial intelligence, and cloud storage and other areas. So FM has invited those companies to invest in India as well. On the other hand, she's addressed a Hoover institution in Stanford University, and she there also tried to hard sell India's growth story, how India during COVID fought really hard. Now it has come out of the pandemic. It has worked hard on its reforms as far as infrastructure is concerned. It has laid a lot of emphasis on infrastructure, capital expenditure. So world is welcome to come and invest in India. But more than that, what is important is India's clearly outreach in US at a time when tariff chaos is happening across the world. India is discussing a BTA with America, and it's going to be finalized in the next 4 to 5 months. That's why these meetings are important. It's a back-to-back visit of FM to first UK, then Austria, then US and Peru now, and after that she'll go to Milan. So within a month, she will have a lot to do when it comes to geopolitics. And it's important and rightly timed also because geopolitics is at the center stage now, more than ever in history. Tariff wars have created havoc across the world. That's why these visits are more important.
Well, thank you, Sumit, for getting us the latest on Finance Minister Nirmala Sitharaman's global visit and the significance of these visits. Now it's time to take a very short breather on this edition of Market Cafe. We'll be right back. Stay tuned. Welcome back to Market Cafe on ET Now. You're watching it with me, Kanishka Sarkar and Shreyansi Singh. Well, moving on, let's get you a quick Asia market check. Well, the Asia Pacific markets traded subdued after Trump's attack on Fed chair, which also sent the Wall Street stocks tumbling. Now, this morning, Japan's Nikkei 225 was trading flat. Remember, the Bank of Japan is likely to pause rate hikes in its May meeting, in part due to market uncertainty and softer inflation as per many projections by analysts. Over in South Korea, the Kospi index is down more than 0.5%. Hong Kong's Hang Seng Index was trading slightly lower as well, down about 0.2%, whereas China's Shanghai Index is up about 0.17%. Now, remember, all these moves are coming after After US President Donald Trump has doubled down on his pressure campaign on Federal Reserve Chairman Jerome Powell, now the Asian stocks are tracking the Wall Street, where sharp declines were seen in overnight trade. Now if you look at cues for Nifty back home, the Nifty ended around 24,125 level yesterday. At this point in time, the implied Nifty suggests a gap up opening at around the 24,160 levels. Well, those are the cues that we are tracking as far as the Asia markets are concerned, and of course the Indian markets as well.
On the government swinging the tariff sword again, this time to shield India's steel makers from a flood of cheap imports. In fact, a 12% provisional safeguard duty has just been slapped on select steel products, effective immediately for the next 200 days. Why now? Because, well, you do have Indian manufacturers that have been sounding the alarm for months, warning that surging shipments from countries like China and Vietnam, often at rock-bottom prices, are threatening to undercut domestic production. We do have Prakash Priyadarshi standing by with some more details.
Yes, it's a big relief for domestic steel producers as the government has decided to impose a 12% safeguard duty on some steel products effective from April 21. A very significant development, especially in the context of rising cases of dumping, especially from countries like Vietnam and China. Industry has been approaching government for its intervention to protect their interest, following that the government had asked DGTR, comes under Ministry of Commerce, to undertake thorough investigation and submit report, which was submitted last month, where it has clearly mentioned that at least 12% safeguard duty should be imposed on some steel products to protect the interests of domestic industry, as there was clear evidence of dumping cases. Therefore, the government has now come out with the final notification. However, these duties are provisional in nature, will be applicable for next 200 days, after which government will review the situation before taking further decision. This duty will be applicable in a range of $75 to $964 per metric ton. The development is also very crucial in the context of US government's decision to impose 25% uniform tariff on steel and aluminum products, which poses potential threat to domestic industry, and therefore government has come out with the final notification where a 12% safeguard duty will be imposed on some steel products.
Thank you, Prakash, for getting us the latest on steel safeguard duty. But now let's also understand what are the implications for India. Ashesha joins in with the analyst take on the same.
Well, absolutely. Analysts believe that most of the positives have already priced into the stock, and this is because, remember, in December 2024, DGTR had launched an investigation for imposition of import duty on import of steel, especially from countries like China, Japan and Korea. And it was in March 2025, a couple of months ago, when DGTR had recommended 12% safeguard duty. This 12% safeguard duty, which has finally been announced, is exactly in tandem with what DGTR had recommended. So there are no positive surprises as such, and this is largely in line with what the street was penciling in already. Now, interestingly, Morgan Stanley has also come out with a report where they believe that yes, this is a positive development. Steel stocks are expected to react positively in the short term, but they believe this positive reaction should be taken as an opportunity to get out of steel stocks. And they say this because domestic steel prices, HRC prices, currently are at an 18% premium as compared to import parity prices, and even after the safeguard duty is imposed, domestic prices will still be at a premium of about 5 to 6% as compared to import prices. So Morgan Stanley does not see any case for domestic prices to lift on account of import duty that has been imposed. So yes, for now looks like this is in line with what the street was working with, but this will not provide any kind of boost or support to domestic steel prices, because most of it has already been factored in, and even after import duty is imposed, probably domestic steel prices will not inch higher. So we don't expect any kind of bumper movement on steel stocks in today's trading session.
Rather than moving on, JSW Energy in fact is betting on a 16,000 crore capex to set up its largest greenfield power plant in West Bengal, which according to the management will be the most competitive in terms of capital cost per megawatt among recent projects. In fact, in a chat with ET Now, you did have the joint MD and CEO Sharad Mahindra sharing their investment pipeline as well as capacity targets. Let's go across and listen in.
A high significance project both for the state of West Bengal as well as JSW Energy. When I talk about JSW Energy, see, we are moving ahead with keeping in mind the energy requirement which is happening, one, energy transition which is happening towards green energy, and also the reliability of the power. So I think this particular project is a part of our JSW Energy being seen as a reliable supplier and a stable supplier, because we have all been seeing that significant capacity addition is happening in the renewable energy space. This is our largest investment in thermal in greenfield area and in the state of West Bengal. We are well on track for 20 gigawatt, and with the order pipeline of more than 18 gigawatt what we have, we are absolutely certain that 20 gigawatt will be happening significantly earlier, maybe a few years earlier only, not by FY30, and at the right time. We will be definitely, that was a strategy 2.0, now we'll be making an announcement of strategy 3.0 for FY30, which will be revised upward.
All right, that's the latest word coming in from JSW Energy. Now moving on, let's get you an update from the banking space. Well, the RBI has just turned the liquidity tap a notch tighter. Now, in its final guidelines to tweak the LCR, or liquidity coverage ratio, the central bank is asking lenders to treat digital age depositors with a bit more caution. Now, going forward, banks will need to assign an additional runoff rate of 2.5% on deposits held by retail and small business customers who use internet or mobile banking. Well, why? Especially because the RBI thinks that these tech-savvy depositors are more likely to pull out their money quickly in times of stress thanks to the ease of a few taps on their phones. Now, the move is part of a broader recalibration of how banks measure and prepare for short-term liquidity shocks, especially in a world where panic withdrawals could go viral faster than ever before. Ankur joins us now with a full download on what this means for your bank, your app, and your next click.
Yes, Reserve Bank of India has issued final norms on assigning additional runoff factor for internet and mobile banking enabled deposits. Now, in the amendment of LCR framework, Reserve Bank of India is now saying that 2.5% of additional runoff factor is sufficient for banks against a proposal of 5% additional runoff factor which was proposed in the draft norm. So, final norms have only suggested 7.5% of additional runoff factor for banks for stable deposits, and otherwise it needs to be 12.5% additional runoff factor which was earlier 10%. So, all in all it looks like that it will be net positive impact of 6 percentage point on aggregate LCR levels of banks. And not only that, Reserve Bank of India has reduced rate for wholesale funding from non-financial entities like trust, LLPs. Now, this has been reduced to 40% from 100% earlier. Overall, the guidelines which were proposed for enhancing liquidity resilience and align with global standards that needs to be implemented from 1st of April 2026. Remember, earlier implementation date was planned for 1st of April 2025, but it was deferred, and now finally Reserve Bank of India has actually halved the additional runoff factor which is required for banks where internet and mobile banking is enabled.
Well, absolutely. That's a big breather coming in. Thanks, Ankur, for getting us all of those details. You do, in fact, have ICRA also that has also said that lendable resources are going to get a boost to the tune of 2.7 to 3 lakh crore rupees. So definitely an important move coming in right there. But tell you what, let's help you start your day right with some important commentary coming in amid the global uncertainty around tariffs. We caught up with Kenneth Andrade, who's the founder and CIO at Old Bridge Capital Management, got his take on the ongoing scenario that will likely pan out for US, China as well as India. He also lists out the sectors that he's bullish on. Let's go across and listen in.
So in this investment environment, if you have to look at a macro picture, any country with a trade surplus has a problem. Everyone with a trade deficit doesn't have a problem.
So India has a trade deficit with US?
I mean, that's That's where we stand as far as an investment structure is concerned. If you have to pick stocks, or if you have to pick countries. So that's exactly where we stand at this point in time.
So as an investor, because Kenneth, there's so much flux in the world right now. As an investor, what do you take as markers to dictate your investment strategy? You've already had a correction in India. You're sitting on cash, waiting for the opportunity. But now looking at what's happening since April 2nd, you're wondering whether this is the opportunity or not. I mean, do you have, like you rightly said in your note as well, I mean, should you be discussing valuations and stock prices? Should that be the only benchmark right now to try and figure out where to park that money?
I think we'll be the strongest part, we'll be an economy with having a strongest growth footprint across most other countries in the region. So if you have to take that narrative out, valuations and stock prices at this point in time, you take a backseat. You just become an asset allocation country.
Okay. So while the consumption may migrate, it will shift from one place to another place. If the per capita of other countries is much lower than US, then what happens to the absolute demand?
I mean, next 2 years, don't expect any radical shifts.
Okay. So if I am an investor, should I be using this as a time to buy into companies which would benefit because of this shift? And if yes, where are those spots and which are those sectors and companies which would benefit?
So any Indian company, any company, okay, who's on the right side of the trade, feeding into the US's cash pool. Like I said, the inventory liquidations creates a cash pool and no one's resupplying that money. I think that's where you have to pick the transactions. Okay, any non-discretionary consumption in the US will do extremely well.
Non-discretionary consumption, okay.
Okay. Any industry which is working with efficiency of the entire corporate structure in the US, I mean IT is one of them, that should continue to do well. If it's not doing well in the last 1 year, I think it might change trajectory in the next 6-7 months. Okay, so that's essentially where we are. And in a slightly more medium term, I think the rest of the world is also going to go for a capex cycle. Right now, for the next 1 year, till all of these, till policy clarity is not there, there's not going to be too much of a capex cycle. Capex is dead across the world.
So you said earlier that India is going to be a beneficiary of capital allocation or reallocation in the current scenario. But that capital, assuming that you're talking about FPI, FI money, that's only going to change the obvious names, right? The large cap banks and maybe IT.
Let's wait and see. I have a slightly different opinion right now.
Which is?
No, it will be much more broader.
Okay.
Okay, and one thing about foreign capital coming into the country, it is also reasonably sensitive on what pricing that they pay for these companies and businesses. So we'll have to wait, watch, and see how the cycle actually moves on. But I mean, I don't think we need to worry too much about the slowdown that's happening across the world. We will continue to maintain an element of growth. It may not be as high as we thought it would be, and we could continue to plod along. The sectors will be very, very traditional in nature. I think we've seen a slowdown happen in the domestic economy for the last 6 months, 9 months, 3 quarters. I think that will continue to be there. So if you ask me, between investing in the domestic economy or investing in businesses that are going out for growth, you will still have a growth, a complex of companies which will grow, which have to still establish global market shares, because that is the cash pile and that is the pool of opportunity that is there. In the domestic market, if you're going, if you're looking at domestic-led businesses, you have to be very sensitive about valuations, because growth might be capped for a while.
You're talking India here.
About India. Companies addressing the domestic market, there's no point in building up a growth multiple in businesses that are just addressing the Indian markets.
Your thoughts are very different. I mean,
yeah, I was just going to come to that, because what does it leave you with? Because if you're talking about the domestic linked sectors, if you're saying capex is going to slow down, economy is going to take a stall, I mean, what's left there?
So in the domestic environment, I think financials after a long time have come to valuations where you could break up and make an argument for some of them. Okay, but that's a nice place to be in, nice place to hide. tech, metals or primary base metals, again a nice place to hide because the intermediate, intermediate products that are there have got valuation, sorry, I won't say valuation, have got pricing power, so profitability will be reasonably strong. Okay, and volume growth will be also a single digit. Those are two sectors that are domestic that could be okay. A lot of consumer businesses have corrected very, very sharply. Okay, and there you have to go stock picking. It's not a growth market at all. So the markets will narrow down. Will it be as finite as it was in 2018-19? I don't think so. The market, if you're addressing domestic companies, will narrow down. But any part of the world, any company, and this is what our portfolio reflects. Any part of an industry which is targeting inventory restocking in the West. Okay, we should be. I think that's where the growth metric lies. It's difficult to calibrate what kind of growth is there, if there's growth at all. But I sense that over the next quarter or 2 quarters, which is as soon as that, we could see a material difference in businesses there.
So other than IT services, what could be it?
We look pharmaceuticals. So look at non-discretionary spending in a world economy which is slowing down, and I think you will get most of those answers out there. Pharma, a lot of services, okay, and a lot of services including IT. And if you can address some part of the textile value chain out there, not all of it, textile value chain, non-discretionary, I think that's some ideation out there.
Welcome back to ET Now. You're watching Market Cafe with me, Kanishka Sarkar and Shreyansi Singh. Well, let's get to the earnings space now. HCL Tech is all set to deliver its Q4 numbers, and a weak set is expected this time around. My colleague Ansh joins in with more details. Good morning, Ansh.
HCL Tech is set to report a mute set of numbers for this quarter. So actually in constant currency, we are seeing that revenue is likely to decline by 0.3% sequentially, whereas in dollar terms, revenue is expected to go down by around 0.7% on quarter-on-quarter basis to $3,507 million. Whereas if we talk about in rupee terms, then that is expected to rise by around 1.6%. But the main revenue decline could be on the back of a weak seasonality in product business and continued softness in manufacturing sector. Apart from this, if we talk about margin, then that is likely to decline by around 150 basis points from 19.5% directly to around 18%. And this is mainly on the back of partial wage hikes of senior employees. If we talk about net profit, then that is expected to go down by around 6.4% to 4,298 crore. Now, if we talk about FY26 guidance, then revenue is expected to be in the range of 3 to 5%, whereas operating margin is likely to be in the range of 18 to 19%. But apart from numbers, there are 5 key things to watch out for. First is management commentary on demand. Second is integration and performance of recent acquisitions. Third is discretionary spending outlook. Fourth is deal pipeline and GenAI opportunities. And fifth is headcount and attrition trends.
Well, absolutely, Ansh. Thanks for getting us that update. So there you have it. That's what is being penciled in when it comes to HCL Tech. Thus far, you've seen muted set of earnings coming in. As far as the IT pack is concerned, so all of those stocks, especially HCL Tech, will remain in focus. But tell you what, let's also take a look at the list of stocks that you should be looking at. And Gaurav is standing by, in fact, with just that list.
Well, yes, first let's talk about Mahindra Logistics, because this company came up with a good set of numbers. Why I'm saying is that when we talk about net profit, actually company reported losses of around 12 crores a year ago, and now they have reported losses of around 6 crores. So they have narrowed down the losses. On the other hand, when we talk about EBITDA margins, there also we have seen an improvement. EBITDA margins now stand at around 5% versus what it was at 3.9% a year ago. Other than that, HUL is in focus because company has completed acquisition of 90.5% stake in Uprising Science, and the total value of this acquisition is around 2,706 crore rupees. Tata Power is also going to be in focus today because Tata Power Renewable Energy has signed an agreement with Tata Motors, and they will be setting up around 131 megawatt of wind power energy hybrid project for the company. Brigade Enterprises is also in focus today because company has signed an JDA for a land which is situated in Bengaluru, and the gross development value of this land is worth 175 crore rupees. Paytm is also in focus today because Paytm has now introduced a reduced interest rates and revised brokerages. Interest rates have been reduced to 9.75% versus what it was at 14.99% per annum. And lastly, let's also focus on Coal India because company has signed an MOU with Damodar and Valley Corporation. With this, they will be setting up supercritical power plant in Jharkhand, and that is the reason why this company is also going to be in focus. So definitely watching out on all these stocks on the back of the news flow that I received in the morning.
Thank you, Gaurav, for getting us that list of stocks to keep on our radar today. Lots of stocks to keep an eye on this morning. Now, moving on, SIP flows remain intact even if there's a temporary slowdown. That's what A. Balasubramanian of ABSL AMC has said, as he notes that unique investors have doubled in just a few years. He also advises new investors to stick to their SIPs and not time them on the basis of short-term volatility. Listen in to his comments.
So the new world initially was looking extremely uncertain, but I cannot say that uncertainty is still not there. Uncertainty is there, but I think the impact probably could be a bit diluted. And second, from India point of view, probably is a great opportunity from India point of view. I think the way the government has been handling quietly without making much noise and looking at more deeply in terms of how Indian model can get adjusted, especially from the trade point of view. My belief is it might turn out to be a big beneficiary, rather India could become a big beneficiary of the whole stuff. Even from analyst expectation point of view, the earnings coming down is also already been predicted. It's not that people are still bullish on earnings and then expecting companies to outperform the analyst expectations, that's also not there. On the contrary, most of the downgrades happen from analyst point of view. In all probability, the company either will start meeting the analyst expectations or marginally outperform the analyst expectation. That might also begin. Therefore, my own belief is it's already there in the price. And the last 2-3 months, even government expenditure, especially towards infrastructure building, already started seeing somewhat of gaining momentum, and the GST tax collections continues to remain somewhat robust. I think from look at it from multiple angles, I think it must be there in the price, I would say. And on top of it, Reserve Bank of India and moving towards the easing of monetary policy, and despite knowing the fact that international volatility, in the historic standard if you take, whenever currency become volatile in global market, I think Indian central banker generally don't touch the interest rates. And this is the first time I think they are touching the interest rates, knowing very well international uncertainties remains. But as far as we are concerned, we have to focus on our growth. And inclusive growth that I think India has been talking about, that's something the Reserve Bank of India is also supporting them by way of cutting interest rates, taking steps towards improving the liquidity. So all those things, my view is good moving parts, which ultimately start delivering the right impact as we move forward.
But one way of looking at this SIP number is the number of new unit holders or number of new applications. One way is that look at the total kitty. And third is looking at the number of gross cancellations. So from a benchmarking standpoint, last 3 months markets were bad. A lot of 2-3 year SIPs have gone negative. What is the right way of looking at SIPs? The net number, the gross cancellations, new additions?
I think the way I always look at Nikunj is the best way to measure the level of participation is the gross number, which is the gross number about 26,000 crores is the number which comes in. Net inflows after say cancellation etc. would be in the range of about 15 to 18,000 crores. Then of course industry doesn't disclose the net number because we always look at the gross number. The gross volume is actually represents level of interest that come from investors. It also represents the level of understanding that people have got in building the SIP from longer term point of view. So that's why I always look at it. Second, we have to look at how many number of new investors also keeps coming in. I think you'll have a new participants. Today we have about 5.2 crores unique customer base. Same number just about 3 years back, it was just about 2 crores.
Yeah, it's
been
doubled.
growing.
It's doubled.
I think what is most important for Indian mutual fund industry is that's why I keep saying all the time that I think the landscape completely got changed from a server's point of view to invest in mutual funds now by way of SIP now become the reality. Therefore, the number is the gross number keeps rising, new investor keeps coming in.
Fair point.
And every fall in the market.
Such a small number, I would say.
Which one?
I'm saying still it's a small
It's a small number,
It's
yeah.
still very underpenetrated.
1.4 billion is India's population. You take out the extreme ends, which is 20% on the top, 20% on the bottom. You still have like a 90 crore Indians who potentially can be directly, indirectly come into it. You divide that by, or let's look at number of households. 40 crore households. You take 20% out, and you knock off 10% duplication. That's 30%. So 40 into 30% is 28 crore. It can still reach up to about 20, 25 crore households.
Correct.
So Bala, can I say that, and this is a number we take a lot of pride in, all of us take a lot of pride in, that in this last 3 months, when the markets were in a tizzy, the SIP collections were robust. Barring this number which may mathematically be at a 4-month low, that's maths. But in general, the number now comfortably seems to be north of 20,000 on a monthly basis at gross level.
Yes.
So the Indian SIP investor has not panicked in this turmoil.
Absolutely no. Absolutely. Even the lump sum investors would have panicked not because of not being comfortable with the mutual fund.
In last 3 months, have you got more outflows or inflows across categories?
There's inflows.
All categories, even in small and mid cap?
We have seen inflows coming in large cap, flexi cap, multi-asset allocation fund. We also seen inflows coming in the hybrid funds. Hybrid funds have been getting a lot of inflows. Even fixed income funds. Some of the fixed income funds, people on the base of expectation of a rate cut, and a lot of people have started coming into the fixed income funds. I even believe as we move forward, even the liquid fund will start getting flows, given the fact that the rate in savings bank account rates are being now cut to about 2.5 to 3%, and liquid funds would generate about 6 to 7% on an average, roughly. That's investing in about 90 days money market instruments. I'll also see participation coming even in the liquid fund as part of their parking of their money in the mutual funds. Therefore, if you look at in the equity space, we are seeing across all categories, including small and mid cap, though the noise levels on small and mid cap could be more not favorable kind of thing, not negative I would say, not favorable, but still flows in small and mid cap also start coming in, given the fact that one, asset allocation plays a role, and SIPs come for a longer term, it's for a perpetual, and that's something we have understood. And people also understood conservative investors can actually choose the hybrid funds. Hybrid fund also has seen this amount of growth. I think it's coming across the category, I would say.
Alright, then moving on, let's get you some more commentary then. While it's time to be cautious in the market, India seems relatively better placed versus other markets. And that's the word coming in from Jefferies Mahesh Nandurkar. He in fact also adds that he will be sticking to domestic facing sectors for now while avoiding IT and metals. Let's go across and listen in.
Not a market, where one can take a very adventurous call. One needs to, sort of take a more measured approach, take a little bit of a cautious approach as well. Evaluate the stocks and sectors more on their merit in terms of what the valuation is, what is the market expecting. And I would say, basically, take a slightly cautious approach. If it goes up too much from here, the market goes sort of too much from here, maybe book profits and buy only when, you see some dips. But that too, I would say, in sectors where there are predictability, in sectors where there is valuation comfort, and in sectors, in my view, which are more domestically oriented rather than the global or the outward-looking businesses.
How much of the bad news is in the price? It's important for us to look at that, okay, how much of this entire tariff adjustment to global trade and global GDP is something what markets have already factored in?
I think to my mind that to a large extent, those risks, have been factored in, in terms of the sentiments. Obviously, what is not factored in at this point in time is the impact that these tariff adjustments are going to have on the US, in my view, and what kind of a slowdown that will be seen in the US or maybe seen in China, because those are the two economies that seem to get impacted the most. Given the uncertainties around the policies from the US has gone up so much, I believe that US is no longer the most favored destination in terms of incremental flows going forward. And money will be finding its way into non-US assets. For the last few months, barring the last few days, it was Europe and China. But given this tariff war, even Chinese markets have also corrected. So I think non-US markets, non-dollar assets are going to see a positive inflow, and India will get its own share as well. So on a relative basis, I would say it is easier to make a call that Indian market should do better as compared to their other global counterparts. But that could mean that India falls less as compared to the rest of the world. It is not very easy to say that whether Indian markets will rally big time from here on. That's a very difficult statement to make. But so it's a relatively easier, I would say, decision for a global investor as to which markets to own. I would definitely say India is looking far better.
That's the expert commentary coming in from Jefferies. That's the sectors and stocks that Jefferies picking and preferring and avoiding right now. But let's also look at the FMCG and consumption theme at this point in time. UBS has come out with a note on the space stating potential factors that could lead to a demand revival in that space. Snehi is here to tell us more about it.
Well, absolutely. UBS this morning has come out with a note on the entire consumption and FMCG space, and they believe that the consumption space is now a Goldilocks in the making, and it looks like the sector is ready to rebound. Earnings they're expected to recover in FY26, and UBS sees a 13% growth in FY26 earnings, and this is after a weak FY25, of course. They believe that on the margin front, margin headwinds will start receding from the second half of FY26, bringing in EPS growth to an inflection point that could also be a key catalyst for the sector going ahead. Now, they've listed out some factors that could boost demand for the FMCG space in FY26. They're saying that potential income stimulus via lower taxes could be something that could boost demand. They're also saying that rural demand is already looking resilient, and the Rabi output this time is also expected to be robust. Falling food inflation should aid recovery in the mass market, especially when it comes to urban consumption. The upcoming 8th pay commission over the next 3 years should also aid FMCG going ahead. Valuations have corrected significantly, as much as 35% since October last year, and the sector offers defensiveness in the market that is still slightly volatile, and it's good for people to who have a low risk tolerance, is what they're saying. Lastly, when we talk about this stock specific preference, they prefer DMart and Trent as income stimulus plays. They also believe that HUL and GCPL are in for a turnaround. Colgate, Britannia, they believe are at an inflection point, with earnings growth revival likely by next year. Now, they also see appealing value in ITC after a correction in their tax fears. On the flip side, their least preferred or least favored picks from the consumption space are Asian Paints, as the disruption cycle brings uncertainty, and Dabur on the back of their portfolio issues. And they also believe that Jubilant also has their SSSG rebound already priced in, so they don't see much momentum going ahead. But that's the roundup coming in on FMCG from UBS on the entire FMCG and consumption space.
Well, absolutely. Thanks, Nehi, for getting us that roundup. But with that, completely out of time on this edition of Market Cafe on ET Now. Thank you so much for tuning in.
In association with SBI.